So what are fair value gaps? Well, that's a good question. In order to understand what a fair value gap is, you have to understand how candlesticks form. All candlesticks, bullish or bearish, have four main components: the open, the high, the low, and the close. In a bearish candlestick, the open is the top of the body and the close is the bottom of the body. The high and the low never change. On a bullish candlestick, the open is the bottom of the body and the close is the top of the body. The high and the low still never change. Once you understand these four main components of candlesticks, you can begin to start looking for fair value gaps. Let's get into those next. The easiest way to explain what a fair value gap is to look at it on the chart. You'll see three candles: candle A, candle B, and candle C. A fair value gap is formed when candle A and candle C do not share a common price. Candle A and candle C do not share a common price because the low of candle A, which is the lowest wick, does not touch the high of candle C, which is the top wick. These gaps can be important because it shows that there is an imbalance in price. By candle C not retracing and touching candle A, it shows that no buyers participated in the flush down during candle B. These gaps are cool because they tend to act as magnets for price, and price always seems to find their way back into these gaps, and they can be used for entries or exits for your positions. So this is the gap from the example, and if we draw it, we'll see candle A from the low to the high of candle C. I like to use these rectangles, and I have a nice template set up, and I use minus fair value gap for a bearish fair value gap. Bearish just means the gap was formed on the way down. Bullish would mean the gap is formed on the way up. For example, this was a bullish fair value gap. And you can see price eventually came back and filled itself. The market likes balance, so the reason these fair value gaps get filled is because the market is balancing itself out. So as you can see here, if we play the next candle, the market came into the bottom of the fair value gap and sold off. This is a trade you can take. Some people like to trade the bottom of the fair value gap bounce down or top up, depending on what type of fair value gap you're looking at. But it can be a risky trade because there's no guarantee that price won't come up and fill this gap right away. Let's see what price does after. You can see that price eventually does come back up, fills the gap perfectly. It wicks through it. Now, some people like to call fair value gaps filled when the body closes the gap. I personally see a gap filled when the wick closes. And then you can see the strong price sensitivity down and probably formed yet another gap. These gaps will form all the time, all over the place. This is the daily chart. So you can see them on high time frames if you're a long-term swing trader. You can see them on low time frames like the 5-minute. Plenty happened today. Candle A, B, C. A and C do not share a common price. This is your imbalance in price or your fair value gap. With these gaps, there's a couple ways to trade them. I actually did trade one today. I will show you guys that trade. Let's get out of replay mode and go back to the 15-minute this morning. So there was a 15-minute gap here. And it was a bearish fair value gap because it was formed while price traded down. And we label it like that. And this morning when I woke up, I was on the 5-minute, and I saw how price came up, almost closed it, about a tick away. So I entered right here at 36.39, and I took profit also in a gap, which was located actually on the 15-minute, but I was looking at the 5 at the time. And this was our 15-minute gap. And if we go back to the 5, I entered right here and I exited within this gap. So you can use gaps for your entries and your exits. Obviously you can use them for your exits, and why it's good to do so is because that's where liquidity lies. So there could be a reversal inside of a gap. So I wouldn't want to try to hold for longer than the gap. Now granted, price did go down another 13 points or so, but I played it safe. I took my low-hanging fruit because I knew that price could reverse, and obviously it did after a while. not really a while, probably 30 minutes, 20 minutes. So 10 minutes after the open, price reversed and went higher and eventually closed this gap up here. So there's a lot of different ways you can play fair value gaps. They're everywhere. You just have to be careful of your high time frame analysis. So you have to have a narrative on why price could go where it's going, and then a gap could give you a good entry to get in. Let's look for some more. So here, bullish fair value gap. Price came up, formed the gap, traded back into it, and then took off long. The way you could have traded this long if you were up this morning is to take it long from the top of the gap if it fits your risk to reward. I typically would like to hide my stop underneath this swing low here that formed the gap, so it might not have been a good risk to reward position depending on how much you like to risk. So let's say we entered from the top of the gap and our target was this other gap above. Our stop was below this low. So your stop would have been 8.75 points, so 8 points and 3 ticks, and your target would have been 16 points, almost a 2-to-1 risk to reward, give or take, on this trade. So this is a way that you can trade gaps. ICT teaches gaps, and you can trade them. His mentorship model takes out liquidity, which is taking out a higher or low on a higher time frame, and then look for the gap in the opposite direction and then take it from the bottom or the middle, depending on your risk to reward again, and take it back in the other direction. Gaps are everywhere. You should practice finding them on your charts and seeing how price reacts to them. So for example, here's another one. Price traded up, formed a gap, A, B, C. A and C do not share price. This is bullish because it's going up, so I would have my plus fair value gap here. Price traded down into the gap. You took it long off the top of the gap, although there was another one below it, so you would have been taking a little more risk. And then obviously price never came back there the whole day. So gaps are pretty powerful, but it does require some high time frame analysis. But hopefully this was helpful in just determining what a fair value gap is, how you can look at them, how you can trade them, why price reacts the way it does, because the market loves balance. For example, here's another one. Price formed the gap, traded into it, traded back up. So pretty cool thing in price action. It's definitely a key to learning to read price action. Once you get really advanced, you can start seeing gaps before they form. You can start seeing where price may bounce, whether or not a gap fills or not, and cool things like that. So hopefully this was helpful. If you guys like these type of videos, let me know. I will make more. And until then, y'all have a good one.